February 23rd, 1995, 8:47 a.m. Singapore time. The Singapore International Monetary Exchange issues a margin call to Barings Futures Singapore. The amount required, £827 million. Barings Bank's total reported capital, £540 million. The arithmetic was final. Barings Bank, financier of the Napoleonic Wars, banker to the Queen of England, survivor of 2 centuries, founded 1762. It would not survive the weekend. The cause was not a market crash, not a credit crisis. It was a control failure. Barings & Company was incorporated in 1762. By 1995, it was the oldest merchant bank in the United Kingdom. It held the royal warrant, private banker to the British royal family. In March 1992, Barings established Barings Futures Singapore, a subsidiary to execute low-risk arbitrage in Japanese derivatives. The operation was managed by Nicholas William Leeson, age 27 in 1992, former settlements clerk, no university degree. Leeson's reputation inside Barings was built on a single assignment, Jakarta, 1990. The Jakarta office had £100 million in stock certificates and bearer bonds and administrative chaos. Trades could not be settled. In 10 months, Leeson resolved it. He organized the certificates, cleared the backlog, and restored operational function. This earned him the label, problem solver, someone who could fix what senior management avoided. When Barings opened BFS in Singapore, Leeson was given 2 roles. He managed trading execution on the floor of Cymex, and he managed the settlements and reconciliation in the back office. In standard banking operations, these functions are segregated. The person who trades cannot be the person who records the trade. An internal audit in August 1994 identified this as a material control weakness. The recommendation was immediate separation. The recommendation was not implemented. Leeson was too profitable to disrupt. By the end of 1994, Leeson was reporting profits of £28.5 million. He was the most profitable contributor in the Barings Group. The actual position was a loss of £827 million. This is the reconstruction. On July 3, 1992, Nicholas Leeson opened a trading account on the Cymex system, the 5/8 account. Cymex classified 5/8 account as an error account. Its purpose? Temporary holding for minor execution mistakes, trades entered at the wrong price, incorrect quantities, clerical errors. Standard procedure. An error is recorded, corrected within 24 to 48 hours, and the account is closed. The balance returns to 0. Leeson did not follow standard procedure. According to court records, Leeson stated the first loss hidden in the 5/8 account was approximately £20,000, the result of an execution error by a junior trader on his team. He concealed it to protect the employee from punishment. The concealment succeeded. London did not notice. The balance began to accumulate. Leeson's official mandate was switching. This is distinct from arbitrage. The Nikkei 225 futures contract traded on 2 exchanges, the Singapore International Monetary Exchange and the Osaka Securities Exchange. When prices diverged, by as little as 50 to 100 yen per contract, a trader could buy on one exchange and sell on the other, capturing the spread. This is a market-neutral position. It does not depend on market direction. It depends on price and efficiency. Risk is minimal. Capital requirements are low. Leeson was not switching. Cymex position records show that by December 31st, 1994, Leeson held long positions in 55,000 Nikkei 225 futures contracts, approximately 49% of total open interest on Cymex. Japanese government bond futures representing approximately 85% of the open interest. Combined notional exposure exceeding $20 billion. Barings reported shareholder capital, £540 million. Leeson's derivatives exposure, over £14 billion. He was not managing risk, he was the risk. Each evening, after the close of trading, Leeson's back-office team processed the day's settlements. Leeson instructed them to split the results. Profitable trades were allocated to official client and house accounts. Losses were allocated to the 5/8 account. To balance the ledger, Leeson created fictitious intercompany receivables. The most common counterparty, Barings Securities Japan, account 92,000. The structure was circular. London believed Singapore was generating profit. Singapore reported profit by concealing losses. The losses required funding. London provided funding. Futures trading requires daily margin. When the market moves against a position, the exchange demands immediate cash collateral. As Leeson's positions lost value, Cymex issued margin calls. The amounts grew exponentially. Leeson would fax the Barings Treasury in London. Request: £50 million. Explanation: margin requirements for high net worth client trades. Treasury approved. The trader generating £28 million in annual profit was credible. The amounts seemed proportionate. Between mid-1992 and February 1995, Barings transferred £742 million to Singapore. These transfers were reviewed by Coopers and Lybrand, Barings' external auditor, during the 1994 year-end audit. The audit opinion classified internal controls as satisfactory. No qualification was issued. To generate immediate cash, Leeson sold options, both calls and puts. This is a short straddle. Think of it as selling insurance on market movement. You collect a premium, you profit if nothing happens. If the market moves significantly, in either direction, your losses are theoretically unlimited. Leeson was selling thousands of options. The premiums provided short-term cash. The risk was exponential. When positions moved against him, Leeson doubled them. This is a martingale strategy. The logic: increase your position to lower your average entry price. If the market recovers, you break even. The strategy requires infinite capital and infinite time. Leeson had neither. Barings operated under matrix management. Leeson reported to different supervisors for different functions. Administrative reporting, Singapore. Product strategy, Tokyo. Risk oversight, London. Each manager assumed another was monitoring the details. No one had complete oversight. The Bank of England had granted Barings an informal exemption from the standard rule limiting exposure to any single counterparty to 25% of capital. Without this exemption, Barings could have transferred a maximum of £135 million to Cymex. They transferred £742 million. The regulatory constraint was waived. In January 1995, Coopers and Lybrand conducted their annual audit of Barings. The auditors identified a material receivable, £50 million listed as due from Spear, Leeds and Kellogg, a U.S. securities firm. Leeson produced a letter on SLK letterhead, confirming the balance. He also provided a Citibank statement showing the funds. Both documents were forgeries. The auditors did not verify the letter directly with SLK. They did not confirm the bank statement with Citibank. They did not reconcile Cymex position reports with Barings' internal ledgers. The audit was completed without qualification. According to the Board of Banking Supervision post-mortem, the following procedures were not performed: direct third-party confirmation, independent verification of bank balances, reconciliation of exchange reports, and verification of client existence. January 17, 1995, 5:46 a.m. Japan Standard Time. A magnitude 6.9 earthquake struck Kobe, Japan. 6,434 people were killed. The Kobe port, a critical logistics node for Japanese industry, was destroyed. The Tokyo Stock Exchange opened sharply lower. The Nikkei 225 fell 7.6% in the first hour. Leeson's positions were predicated on stability above 19,000 points. The market was at 17,785. Every 100-point drop increased losses by approximately $50 million. Cymex issued margin calls daily, then hourly. Leeson did not liquidate. He increased his position. He was attempting to support the index through volume. The market did not respond. By mid-February, total margin requirements exceeded over £400 million. Barings had £540 million in capital. Margin requirements were £400 million and increasing daily. There was no reserve. On the evening of February 23rd, Nick Leeson left the BFS office at approximately 7:30 p.m. On his desk, he left a handwritten note. "I'm sorry." He and his wife boarded Malaysia Airlines Flight 0842 to Kuala Lumpur. At 9:15 a.m. the following morning, Cymex officially notified Barings that BFS had failed to meet margin obligations. In London, the Barings board convened an emergency session. For the first time, they accessed the complete Cymex position records. The 5/8 account. Cumulative unrealized loss, £827 million. Capital, £540 million. Loss, £827 million. Insolvent. On February 26, 1995, the Bank of England declared Barings insolvent and appointed administrators. The failure dominated global financial news. The institution that financed empires had been destroyed by a trader in Singapore. On March 6th, Barings was sold to ING Group for £1. ING assumed the liabilities. Nick Leeson was arrested at Frankfurt Airport on March 2nd while attempting to return to London. He was extradited to Singapore, charged with fraud, forgery, and falsification of accounts. On December 1st, 1995, he was sentenced to 6.5 years. He served 3.5 years before early release. On July 18, 1995, the UK Board of Banking Supervision published its official inquiry. The findings were institutional. Failures in segregation of duties, management oversight, matrix accountability, regulatory supervision, and external audit. Peter Baring, chairman, resigned. Peter Norris, CEO, resigned. No senior executive was prosecuted. James Bax, regional manager in Singapore, was criticized for providing false assurances to Cymex regarding client positions. He was not charged. The collapse influenced the development of Basel II, published in 2004. For the first time, banks were required to hold capital specifically for operational risk, including internal fraud. Singapore amended its Futures Trading Act in April 1995, expanding regulatory powers over exchange members. Coopers and Lybrand merged into PricewaterhouseCoopers in 1998. The firm was not prosecuted, but the case became a standard reference in audit failure literature. The collapse of Barings was not caused by market volatility or external crisis. It was caused by fragmented accountability, where no single authority had complete oversight. It was caused by a control environment that permitted a trader to execute, settle, and report his own positions. The warning systems existed. Internal audit flagged the segregation failure. Cymex questioned the volume. Auditors identified discrepancies. What failed was verification. What failed was the willingness to question profitability. The institution that survived 2 centuries did not fail because of one trader. It failed because no one checked.